Everyone, this is Simran Kaur here. We are going for NISM series, especially for Investment Advisor 10A. In this video, we will be covering Chapter 4, that is Investment Vehicles. So let us start with National Small Savings Fund, that is NSSF. The rate of interest on small savings will be dynamic and reflect the interest rates prevailing in the market. Hence, rates of interest will be notified on a quarterly basis. The rate of interest on the Sukanya Samriddhi Yojana, the Senior Citizen Savings Scheme, and the Monthly Income Scheme will be aligned with government securities rates of similar maturity with the spread ranging from 25 basis points to 100 basis points. The PPF 5-year NSC and 5-year term deposit will enjoy spread over government securities of comparable maturity. The 1, 2 and 3-year term deposits, KVP and 5-year recurring deposits will have their interest rates aligned to similar instruments in the banking sector. Also, the rate of interest on an investment made in all schemes except PPF on a particular date remains unchanged for the entire duration of the investment till maturity, irrespective of the revision in subsequent years. In other words, the balances lying to the credit of the PPF account or the fresh contributions made to this account will bear interest as per the rates notified by the government from time to time. So the next topic is Public Provident Fund, that is PPF. Account can be opened by an individual for himself, herself and or on behalf of a minor of whom he or she is a guardian. Hindu Undivided Family, Association of Persons, Body of Individuals and NRI are not eligible to open an account under the PPF scheme. Persons who opened PPF and subsequently become NRI can continue till maturity on non-repatriation basis. Joint account cannot be opened. Nomination facility is available. Account matures after expiry of 15 years from the end of financial year in which the account was opened. Minimum investment amount is Rs 500 and maximum amount in a financial year is Rs 1,50,000. Subscription should be in multiples of Rs 5 and can be paid in one lump sum or in installments not exceeding 12 in a financial year. Eligible for Section 80C deduction. Interest is tax exempt. Its interest is paid on the lowest balance between the close of the 5th day and the end of the month and shall be credited to the account at the end of each year. One withdrawal in a financial year is permissible from 7th financial year. Maximum withdrawal can be 50% of balance at the end of the 4th year or the immediate preceding year, whichever is lower. The account can be continued for a block of 5 years after maturity. The continuation can be with or without contribution. Once an account is continued without contribution for more than a year, the option cannot be changed. Premature closure of the PPF is allowed in cases such as serious ailment, education of children, and such. This shall be permitted with the penalty of a 1% reduction in the interest payable on the whole deposit and only for deposits that have completed 5 years from the date of opening. PPF account is not subject to attachment. However, income tax authorities can attach PPF accounts to recover tax dues. A person can have only one account in his name. Two accounts even at different places anywhere in India are not permitted. Next is National Savings Certificates. Maturity period of 5 years, tax benefits under Section 80C, minimum investment is Rs 500 without any maximum limit. It can be bought by an individual or jointly by two adults. Nomination even with joint ventures is possible. NRI, HUF, companies, trusts, societies or any other institutions are not allowed to purchase the National Savings Certificates. Premature encashment is allowed only in case of death of the holder, forfeiture of by a pledge or under orders of court of law. Certificates are available in denominations of Rs 100, 500, 1000, 5000 and 10,000. Accrued interest is taxable, but is it deemed to be reinvested and therefore the interest becomes eligible for Section 80C benefits. There is no TDS at the time of redeeming the certificate value. Next is Senior Citizen Savings Scheme. Eligibility is 60 years of age or above. NRIs, PIOs and HUF are not eligible to invest in this scheme. Maximum limit is Rs 15 lakh. The benefit of Section 80C is available on investment but interest is fully taxable. Term is 5 years. One-time extension of 3 years is allowed if applied within 1 year of its maturity. Nomination facility is available even in case of joint account. Premature closure after expiry of 1 year but before 2 years. 1.5% of deposit shall be deducted. Premature closure after expiry of 2 years, 1% of the deposit shall be deducted. No deduction is made in case of closure of account due to the death. Nomination facility is available. Next is Post Office Monthly Income Scheme. Term of 5 years. Minimum amount of investment is Rs 1500. Maximum amount in case of single account is Rs 4,50,000 and in case of a joint account is Rs 9 lakh. No bonus is on maturity. Nomination facility is available. If the account is closed between 1 and 3 years of opening, 2% of the deposited amount is deducted. If it is closed after 3 years of opening, 1% of the deposited amount is charged as penalty. Next is Post Office Time Deposits. Terms of 1 year, 2 years, 3 years and 5 years. Single and joint holding. The minimum deposit amount is Rs 200. There is no maximum limit. The 5-year term deposit is eligible for tax benefits under Section 80C. Next is Post Office Recurring Deposit. Accounts can be opened by resident individuals, single and joint modes. Either or survivor option available. Minimum amount of Rs 10 per month and in multiples of Rs 5 thereafter. Interest is taxable. Next is Kisan Vikas Patra. NRIs, HUFs are not eligible to invest in the KVP. Denomination of Rs 1000, Rs 5000, Rs 10,000 and Rs 50,000. KVP can be prematurely encashed 2.5 years from the date of issue. There is no tax incentive for the investment made and the interest earned is taxed on accrual basis. Certificate can be transferred from one person to another and one post office to another by endorsement and delivery. Next is Sukanya Samriddhi Account Scheme. Scheme launched for the benefit of girl children. The account has to be opened in the name of the girl child by a natural or legal guardian. Only one account can be opened in the name of a child, and a guardian can open a maximum of 2 accounts in the name of 2 different girl children. The age of the child cannot be more than 10 years at the time of opening the account. The minimum investment is ₹1,000 in a financial year, and a maximum is ₹1,50,000. The account can be transferred to any place in India. The account will mature on the completion of 21 years from the date of opening the account. If the girl child gets married before the completion of 21 years, then the account is closed. Partial withdrawal is allowed after the holder attains 18 years of age, to the extent of 50% of the amount in balance at the end of the preceding financial year. Any amount deposited in the account is eligible for deduction under Section 80C of the Income Tax Act. Next is Sovereign Gold Bond Scheme 2015. Next is 2015. SGBs are government securities denominated in grams of gold. The bonds are issued in denomination of 1 gram of gold and in denominations thereof. The tenure of the bond is 8 years. The value of the bond will reflect the price of gold. On maturity, the value of the bond may be higher or lower depending upon the prevailing price of gold. The bonds bear an interest rate of 2.5% per annum on the initial investment and is paid semi-annually. Can be bought through the designated banks or post office and the NSE and BSE. The bonds can be held in physical form or in dematerialized form. Early redemption is allowed after the 5th year. The minimum investment is 1 gram and the maximum is 4 kg for individuals and HUFs and 20 kg for trusts. Capital gains on redemption of the bonds earned by an individual is exempt, and capital gains on transfer of a bond before maturity will be eligible for indexation benefits. Joint holding, nomination and the facility of marking lien is available on these bonds. Next is earning per share, EPS. So EPS is net profit minus dividend paid for preference shares divided by number of equity shares. Now the next is dividend yield. So dividend yield is dividend per share divided by current market price of the share into 100%. Now pricing earnings ratio, that is PE ratio. It is calculated as market price of share divided by EPS. In other words, it indicates the number of times the earning per share the market is valuing the share. Now book value. So book value is the equity capital plus net shareholders reserve divided by number of equity shares. Whenever the book value of a company is higher than the market price of the company, it indicates the share of the company is available at a discount. Derivatives. Derivatives are risk management leverage instruments which derive their value from the underlying assets. Futures, forwards, options and leaps, etc. are examples of derivatives. Start with some of the terminologies. Hedging. Hedging is basically protecting your assets from losses and not for maximizing the profits. Arbitraging. Arbitraging is taking advantage of price difference in two different markets for risk-free gains. Next is speculators. Speculators often take positions in futures markets based on their expectations regarding the price movements of the underlying assets without having a position in cash markets. Next is buyer of call option. He has the right but not the obligation to buy the underlying asset at a predefined price on a predefined date. Next is buyer of put option. He has the right but not the obligation to sell the underlying asset at a predefined price on a predefined date. Next is American option. This option can be exercised at any time on or before the expiry date or date. So, European option. This option can be exercised only on its expiry. Next is strike price or exercise price. It's the price at which an option is exercised. Next is expiry date or day. The day or date on which option expires and the contract ceases to exist. Next, exercise day or date. It's the day or date on which the option is exercised. Next, if the spot price is greater than strike price for call option, then it is in the money option, that is ITM. And if spot price is less than the strike price for call option, then we call it as out of the money option, that is OTM. Next, if the strike price is greater than the spot price for put option, then we call it as in the money option, like ITM. Then strike price less than spot price for put option, then it is out of the money option, that is OTM. And if the strike price is equal to the spot price, then it's called at the money option, ATM, for both call and put options. Option premium. So what is option premium? It is the price which an option buyer pays to the seller to buy this option or right. Premium. Intrinsic value plus time value. Next, the intrinsic value of an option is the amount by which option is in the money. Only ITM options have intrinsic value and all OTM and ATM options have zero intrinsic value. ATM and OTM options have only time value in its premium. The time value of the option is also called the extrinsic value of the option.